Many of you would have started investing in mutual funds around COVID, say 2020 or later. And many of these folks who started investments during this period have started investing through the online mode. They do the research online, they invest online. And after that, post COVID, markets were encouraging this kind of a practice because markets were almost going one side. So if you were one of that, how did you feel when this market started falling after September 24? You might have seen returns shrinking from 15% to 12%, 10% or lesser. You might have seen some of your returns giving negative returns of 10%, 15%. And in some cases, if you had started, say, recently, about 8-9 months back or 1 year back, your overall portfolio was down by 15%. How did you feel then? I'm sure it was unpleasant. Probably you never expected, and perhaps you never wanted your investment going in the negative zone, at least not negative by more than 5%. If this is your thought process, what is that you should do now? Please understand, if you had chosen the best performing funds by returns, see, you would have done your online study, and based on whichever was the funds which were given the best returns in the last 10-15 years is what most of you would have made your choice of funds. Is this the way you will choose if you are particular that your fund should not fall by a certain percentage? Absolutely no. Maybe you are not even in the right category. Leave fund choice within the same category. Probably have chosen even the wrong category. When I say this, there are certain sectoral funds which delivered the best set of returns. There might be certain small cap, mid cap funds which would deliver the best set of returns. Mind you, these funds can fall by 15, 20, 30% or even more based on the market fall. If you are somebody looking at 5% or lesser fall and not okay with the fall more than that, these funds are not for you. A conservative investor like you should put almost all the investments in categories like balanced advantage, multi-asset, equity savings, which have a combination of equity. Some cases the equity composition can be more than 60%, some cases it is only 35%. In funds like equity savings, it is only 25% or around that. So the equity composition varies. Accordingly, the risk is so less. You may have to be compromising on your returns because these are not 100% equity funds, but you are choosing this because you are not willing to take a risk beyond a point. For you to build the right portfolio which aligns with your risk profile, you can approach us and we are happy to help you.